Scenario. Question 1, 16 marks. A large UK-based life insurance company which currently specializes in term assurance is planning to expand its product range by offering immediate annuities. The board is concerned about the long-term nature of these contracts and the impact on the company's risk profile. A. Describe the main differences between the risk profiles of term assurance and immediate annuities. 5. B. Explain how the company should apply the monitoring the experience stage of the actuarial control cycle to this new annuity portfolio. 5. C. Discuss the investment strategy the company should adopt to manage the risks identified in Part A, making reference to specific asset classes. Section 1. What we are analyzing. In this scenario, we are looking at a company shifting from a product where they pay out if someone dies too soon, term assurance, to a product where they pay out as long as someone stays alive, annuity. The analysis covers 1. Risk profiles. Why an annuity is essentially the opposite of life insurance. 2. The ACC, monitoring. How we check if our assumptions about how long people live, longevity, are actually coming true. 3. Investment. How we choose the right assets, like bonds, to ensure we have the cash ready to pay these retirees every month for the next 30+ years. Section 2. Logic and strategy. 4a. Focus on the direction of mortality versus longevity. If people live longer, the term assurance provider wins, fewer claims, but the annuity provider loses, more payments. Use technical terms like mortality risk versus longevity risk. 4b. Use the logic of the feedback loop. We need to compare actual versus expected. If actual deaths are lower than expected, we need to increase our reserves and potentially change our pricing for new customers. 4c. Use the principle of asset liability matching, ALM. Annuities provide a fixed, or inflation-linked, income, so we need assets that provide similar cash flows. Think about duration and inflation hedges. Section 3. Model answer. 80 to 95% master's level QMUL. A. Describe the main differences between the risk profiles of term assurance and immediate annuities. 5. The primary difference lies in the direction of the underlying insurance risk. Term assurance is exposed to mortality risk, the risk that policyholders die sooner than expected, leading to an acceleration of death benefit payouts. In contrast, immediate annuities are exposed to longevity risk, the risk that annuitants live longer than the best estimate assumptions, resulting in more monthly payments than priced for. Furthermore, term assurance is typically a short to medium-tail business with relatively low investment risk, as the primary driver of profit is the mortality margin. Immediate annuities are a long-tail business with significant reinvestment risk and interest rate risk. Because the insurer receives a single premium up front and pays out over decades, a fall in interest rates increases the present value of the liabilities, MVL, more significantly for annuities than for term assurance. B. Explain how the company should apply the monitoring the experience stage of the actuarial control cycle to this new annuity portfolio. 5. Monitoring is the critical feedback loop of the ACC. For an annuity portfolio, the company must perform a regular actual versus expected AE analysis on mortality/longevity data. If the monitoring stage reveals that actual mortality is lower than expected, i.e., people are living longer, the actuary must use this information to 1. Update assumptions, revise the best estimate longevity trends in the internal model. 2. Valuation, increase technical provisions to ensure the solvency capital requirement, SCR coverage ratio remains adequate. 3. Pricing, feed the data back into the develop the solution stage to increase premiums or lower annuity rates for new business to maintain commercial viability. 4. Risk response, determine if a longevity swap or further reinsurance transfer is required if the trend suggests a systemic shift in lifespans. C. Discuss the investment strategy the company should adopt to manage the risks identified in Part A, making reference to specific asset classes. The insurer should adopt an asset liability matching ALM strategy to minimize the mismatching risk between the fixed annuity payouts and the investment income. The core of the portfolio should consist of long-dated fixed-interest government bonds, gilts, or high-quality corporate bonds. These assets provide certain cash flows that can be structured to match the expected timing of annuity payments, thereby hedging against interest rate volatility through duration matching. If the annuities are inflation-linked, the insurer must invest in index-linked gilts or property to provide a real yield hedge. While equities offer higher expected long-term returns, They are generally unsuitable for matching immediate annuity liabilities due to their high volatility and lack of guaranteed cash flow timing. However, a small allocation to alternatives, like infrastructure, may be used to provide an illiquidity premium, which is appropriate given that the insurer does not need to provide surrender values on immediate annuities, allowing them to hold illiquid assets to maturity.